Okay, so good evening, class. Let's start our class now. So tonight, we are going to round up on IFRS 16 on leases. That is majorly our target tonight. And last week, we started with IFRS 16 on leases. And I can remember vividly that we stopped on lessee accounting. So what we have today is for us to finish up with lessor accounting. And we mentioned that a lease is a contract, and the substance of that contract is that a lessor is transferring the right to use an asset to a lessee. We said that majorly for us to identify that there is a lease in a contract, the key term there is right to control. And right to control means that it is the lessee that is obtaining substantially all the economic benefit from the use of that asset, which goes to show that it is the lessee that uses the asset and gets all the money that is made from that asset. And it's also the lessee that has right to direct the use of the assets, in the sense that it takes decision about whatever it wants to use the asset to do. Then we look at some questions just for you to understand that very well. And we ended this part of identifying a lease with where a contract has multiple components, because a lease can just be part of a contract. So we looked at this question where it has a normal purchase transaction, and only a part of it was just a lease transaction. Then we moved on to lease term. And for lease term fundamentally is just the period over which the lease contract covers, or the period over which the lessee has right to use the asset. But this period can be extended. It can be extended. And this extension would be considered in the lease term if it is favorable for the lessee to extend. And favorable or not favorable would be determined at the inception of the lease. Then you would decide whether the entire period plus the period of extension is the lease term or not. The key thing we look out for is it favorable or not favorable to the lessee. We solved some couple of questions on that. Then we went on to lessee accounting. And the lessee is the guy, is the tenant, is the guy that has the right to control, is the guy using the asset. And IFRS 16 now requires that the lessee must, at the commencement date, must recognize a lease liability and a right of use asset. A lease liability and a right of use asset at the commencement date. So that is, at the date he enters into the lease, he must recognize these two. And a lease liability cannot be overemphasized in the sense that when you enter into a lease contract, what in layman terms it means is that you want to borrow assets, you want to hire an asset, and you want to use it for an extended period of time, and you're not paying like outrightly, you are paying bit by bit. So IFRS 16 is saying the entire money you want to pay, recognize it now as that you are owing it, because truly you are owing it. Okay, so lease liability at the commencement date, you need to recognize the present value of the lease payment not paid at the commencement date. Of course, it has to be the one you have not paid, because it is that one that will be a liability. And why present value is coming in is because it has to do with future payments. Anytime we are dealing with future payments and reporting, we would have to get the present value. And that at the commencement date. And at the end of the year, you would increase this liability with interest, and we would reduce it with lease payments. And from the questions we solved last week, you would see that this order at the end of the year of adjusting the lease liability at the end of the year, it would depend on when the lease rental is paid. If the lease rental is paid in arrears, that is at the end of the year, it is in that situation that you are going to add interest before you deduct lease rental, because all is happening at the end of the year. But if the lease rental is paid at the beginning of the year, in that case, it will be the lease rental that will be deducted first before you then apply the interest on the balance after deduction of the lease rental. We looked at that last week. Then on the other side of the accounting entry, aside lease liability, there is also right of use assets, which is the underlying assets that is leased. The lessee now is required to put that in his own books also. And we said we'll put this asset in his books at cost. And this cost is two things fundamentally. It comprises the amount you have recognized as a lease liability, which I've said is the present value of the lease rental not paid. Then just add the one you have paid at the commencement date. Then that would give the true picture of the value of the asset, of the entire arrangement. Then if there are any direct costs you add, if there is any initial estimate of dismantling, removal, and restoring the site, like all those directly attributable costs we learned under IFRS 16, you add them. Then that gives you the cost of the asset. And at the end of the year, you're expected to depreciate this asset over the lease term. And that's what this other paragraph is talking about, that we could use the cost model, which is cost minus accumulated depreciation minus accumulated impairment losses, majorly to determine the carrying amount. So all that is saying is that depreciate it. And you could also have an option of the valuation model or fair value model, depending on the leased asset, right? If the leased asset is covered under IFRS 16 and you have chosen to use the valuation model, so be it. If the leased asset is an investment property and you want to use a fair value model, that's also fine, okay? But majorly, the exam will not go in this direction. You will just be required to calculate a right of use asset, and you'll be required to calculate depreciation at the end of the year. We looked at some questions last week. Yeah, so the first question majorly looked at where the payment is made in arrears. That is at the end of the year, I mean the lease rental. Then in that case, I added the interest before deducting the lease rentals. The other question I looked at, the payment was made at the beginning of every year. That in that situation, you see that in the first year, I did not deduct lease rental because the PV, this 130,000 OT6, wouldn't have even considered the initial payment.
The class has started.
Because there's no way
The class has started.
The PV of that, right? There's no way you can really do the PV of that because you're paying it like now. So they would have given you the PV of the remaining payments. So there was no point removing this, right? Because it wasn't even included in this 130. Then we added the interest, then we're carrying it forward and ensuring we remove the lease rental, then adding the interest to applying the interest on the balance, like that, on and on, like that. Another thing that is important in this, like what we did in this first question, is that when we did this schedule of lease liability, when we wanted to prepare our statement of financial position, we ensured that we separated current liabilities from non-current liability. And I explained it in such a way that in this 2002, this 4.5 million is the amount you are owing at the end of the year. And out of this 4.5 million, there is a portion of it that you're going to pay next year. And there's a portion of it that you're going to pay later on into the years. So you need to separate the one you're paying next year as against the one that are due more than 1 year. And I said the easiest way to do that is that looking at this 2002, 4.5 million, you see that at the end of 2003, it has reduced to 3.2 million. That means it is the difference that is due within 1 year. That difference, we're going to treat that as current liability, while the 3.2 million will be treated as non-current liability. That was for 2002. For 2003, we said this 3.2 million in 2003 is what we are owing for the remaining periods. But this 3.2 million, a portion of it also will be paid next year, while the remaining portion will be paid later into the period. So the one we are paying next year, we looked at it by saying, okay, if what we are owing at the end of 2003 is 3.2 million, and by 2004, it has reduced to 1.7 million. That means the difference between that 3.2 and 1.7 that is due within 1 year. The difference, we put it in current liability, while the 1.7 million, we put it in non-current liability. By 2004, we know that the entire balance of 1.7 should be paid next year. Then we put that entire 1.7 as current liability. That was how I explained this last week. And we saw some other questions. And I finalized our class last week by telling you that the idea of the lessee recognizing a lease liability and a right of use asset it's a requirement, but not in all cases, because the standard gives optional exemption. One, for leases that are short-term. Two, for leases for which the underlying asset is of low value. If you have a lease contract that has these two elements, or any of these two elements, then you are exempted, in the sense that if you choose, it's an optional exemption. If you choose not to recognize lease liability and right of use asset, fine, in such a way that the only thing you will just recognize is just the rent you are paying, either monthly or quarterly. Just put that in your P&L, and that's it. That is it for lessee accounting. Today, we would look at lessor accounting. I don't expect we're going to spend more than maximum of 40 minutes in this class. Just to end up this, I'll be closing the class quite early today. So for lessor accounting, the lessor, I will call him the landlord. The lessor, I will call him the owner of the assets. Now, this lessor, he has now transferred or conveyed the right to use his assets to another party. Now, for lessor, for the landlord, IFRS 16 allows him to still classify the lease. It allows him classify the lease. And he needs to first understand what type of lease is he entering into. Because really, two things can happen when you are renting out your assets. Is either you are renting it under a short-term lease in such a way that you are going to get back your asset as quickly as possible, or is a long-term one that there is no likelihood that you get back your asset because the guy is going to use the entire value of that asset. And that is what IFRS 16 is looking at, that those scenarios should not be treated in the same way. Unlike the tenant, as far as the tenant is concerned, it doesn't matter whether he's going to rent it for short or long period. The point is that at that period of the lease, he's using the assets. I mean, that's the substance there for the lessee. But for the lessor, who is the owner that has the assets initially in his books, now that he's giving it out, conceptual framework sees that as that is not an asset that you should keep in your books anymore, because another person now has control over that asset. Now, let's break it down. So IFRS 16 allows the lessor to classify the lease into a finance lease or operating lease. And he said that a finance lease is a lease that transfers substantially all the risk and reward incidental to ownership of an underlying asset. What this is substantially saying is that the asset is not going to come back to the lessor. The lessee is going to use it for all the life of that asset, the remaining life. So the lessor has transferred substantially all the risk and reward incidental to ownership of the underlying asset. So, I mean, that's the core thing. That's the major one. So any other lease whereby the risk and reward is not substantially transferred, then we are talking about an operating lease. Okay. So we would focus more on finance lease because that's the major one. Then we'll look at finance, we'll look at operating lease to close it. So for finance lease, it says is the lease that substantially all the risk and reward has been transferred. Then the question is, how can you know that risk and reward has been transferred? There are 5 points here that you can use to know. A that I have here is that if the lease transfers ownership of the underlying asset by the end of the lease term, then know that that is a finance lease in such a way that there's already an agreement that at the end of the lease term, the assets will be transferred or ownership will be transferred to the lessee. Then it's most likely a finance lease. That is, the risk and reward has been transferred attributable to ownership. Second one is that the lessee has the option to purchase the underlying assets at a price expected to be sufficiently lower than fair value at the exercise dates. That is reasonably certain at the inception date that the option will be exercised. So the point here is this one follows through with the A. So this B is saying that there will be an option to purchase. That is, the lease can buy the asset. And the key thing, the price at which the lessee is going to buy these assets at the end of the lease term will be very small compared to its fair value. It will be very small. I mean, that goes to show that the lessee will have used the assets in such a way that the value is even very low. So the second point here is that there's an option to purchase at a sufficiently lower price than the fair value of the asset at the exercise date. And the third one is that the lease term is for a major part of the economic life of the asset. The lease term is a major part. It's like the economic life is 5 years. You now see the lease term too is 5 years. What's remaining of the asset? Risk and reward has been transferred. Another one is the present value of the lease payment at the inception date amounts to at least substantially all the fair value of the asset. I mean, remember that when at the inception of the lease or at the commencement date, there would be like how much the present value of the lease payment that the lessee usually determine as lease liability, the PV of how much the lessor will collect or how much the lessee will pay. By the time you compare that with the fair value, if they are the same, it's as good as the lessor has sold the asset to the lessee and it now allows the lessee to be paying instrumentally. That's it. Okay. So that also indicates that the risk and reward has been transferred. And finally, is that the underlying asset is of specialized nature that only the lessee can use it without major modification. My dear students, for your exam, you have to know these 5. You have to know these 5 points. And I mean, for finance lease, these are indicators that shows that risk and reward has been transferred, right? And from transfer of ownership to that there is an option to purchase, to the fact that the lease term is substantially or the economic life, to the point that the lease payments, the PV of the lease payment is almost equal to the fair value, and the asset is of specialized nature. I mean, specialized nature means that only the lessee can use it. It could be that maybe the asset is purposely built for the lessee. So, and the guy now gave it to him that, okay, be paying small, small. Be paying small, small. Just like the example we did on multiple components, that manufacturer constructed a machine for that car guy that wants car seats like that. So the asset is of specialized nature that only so I mean just any of them, not the five, any of them shows that is a finance lease. But for exams, you need to know the five. And there are other points, this one are not really major. This also indicates that the lease is a finance is a finance lease, but it's not really it's not significant like the upper five. And what are these ones? This one is looking at that when there are losses on cancellation, the losses will be borne by lessee. I mean, that will only happen if there is cancellation. Or when there is changes in residual value, it will accrue to the lessee. That will even happen only if there is changes in residual value. And the lessee can continue to lease for a secondary term at a rent substantially lower than market rent. So these three, I'm not really a fan of it. And most likely you will not find these ones in your exam. Is those upper five that is germane that you need to ensure you know. Okay, that's a description of a finance lease that shows that substantially all the risk and reward has been transferred. And the way you know that risk and reward has been transferred is those five. Still on finance lease. So if what the lessor has entered into is a finance lease, then how will the lessor now recognize the asset in his books? The first thing is that at the commencement date, the lessor would have to recognize the asset from its books. Remember, now is the lessee that will now recognize the asset as right of use asset. So you don't expect the lessor to be recognizing the same asset in its books. It will de-recognize it. It will remove it from its books. Okay? And removing an asset from your books by accounting, it will probably mean that you're going to credit the asset, right? It's not like you're going to clean. When I say remove the recognized, you're still going to pass double entry. So by the time you credit the asset to lien it off, you're going to lien off the asset. So most likely you're going to create a new account, and that account is called net investment in the lease. Net investment in the lease. Sometimes they call it lease receivable. Lease receivable. So this is quite straightforward in the sense that what these accounts will now show, it will now show the rent you are expecting from the lessee. And that is why the way this lease receivable or net investment in the lease is calculated is by looking at the present value of lease payment receivable by the lessor. Then you add present value of any unguaranteed residual value accruing to the lessor. So this first one, which is the present value of lease payment receivable, is quite straightforward because it's just the rent you're expecting to receive from the lessee. You will just probably get the present value. In the exam, they will give you this amount straight. What we need to dig deeper on is this unguaranteed residual value. Why are we even adding it to what the lessee is expecting? Why are we making it part of the lease receivable? Unguaranteed residual value. The reason is because, you see, the unguaranteed residual value indicates the portion of the residual value that the lessee did not guarantee. Meaning that the lessee, when it takes up these assets under this lease arrangement, he would have given a guarantee to the lessor that I promise you that at least at the end of this lease term, you will get 100 naira from the sale of these assets. Even if you're unable to sell it at 100 naira, if you're able to sell it less, let's say 50 naira, I will make it up for you. Or even if you cannot even sell it at all, that nobody wants to buy it, I will give you the entire 100 naira. That's a guaranteed residual value. However, if the lessor now becomes lucky and sells it above 100 naira, then the lessee is free. Because, I mean, the lessor has gotten the guaranteed amount and even more. However, there are instances where the lessee will promise a residual value, which we call guaranteed residual value, let's say 100 naira. But right from the beginning, the lessor believes that he can get more than that 100 naira. The lessor thinks that he should be able to get like 120 naira. So it's not a conflict between the two, because the lessee is going to say, brother, I cannot guarantee more than 100 naira. The lessor can insist and say, auntie, I think I can get 120 naira. Then, I mean, they would have to still go on with the deal. But that extra 20 naira that the lessor believes he can get, that 20 extra that you think you can get, that is what we call present value. In fact, that's what we call unguaranteed residual value. So when we are getting the value today, that's when we need to get the present value. But it's a portion of the residual value that the lessee has refused to guarantee. But the lessor believes he will get it. Okay. And that is at the beginning of the year. And the same thing at the end of the year, just like we did for lease liability, you would also, because anytime we have done discounting, as you move through time, you need to unwind that discount through interest. So for the lessor now, since him is collecting money, so unlike the interest expense we used for the lessee, for him now it's going to be finance income or interest income. Then you are going to deduct the lease income or the lease rental he's collecting. Let's use an example to explain this simple principle I've just pointed to you. And this question says that a lessor enters into a 3-year leasing arrangement commencing on 1st January 2003. Under the terms of the lease, the lessee commits to pay 80,000 naira per annum. I know it's dollars, but I meant to write naira in all. Per annum, commencing on 31st December 2003. We now said a residual guarantee clause requires lessee to pay 40,000 or 40,000 less assets residual value if lower at the end of the lease term if the lessor is unable to sell the asset for more than 40,000. The lessor expects to sell the asset based on current expectation for 50,000. The interest rate implicit in the lease is 9.2%. The present value of lease payments is receivable by the lessor discounted at this rate is 232,000. You are required to show the net investment in the lease 1st January 2003 to 31st December 2005 and explain what happens to the residual value guarantee on 31st December 2005. Okay, so this is more like it, right? So this guy, a lessor, enters a 3-year leasing arrangement from 1st of January. So where we're going is that the rent we'll be collecting is 80,000 per annum, and this one you will be collecting the rent at the end of every year. Now, they were now told that a residual guarantee clause, so there is a residual value guaranteed of 40,000, meaning that the lessor has guaranteed the lessor that he will get 40,000, right? But the lessor expects the asset that is going to get 50,000. Okay, so the lessor believes he's going to get 50,000, but the amount the lessee guarantees is 40,000. Just like I've explained, the difference is going to be the unguaranteed residual value. So they gave us an interest of 9.2%, and there's a PV. They already gave us the PV of the lease payment receivable as 232,000. So we're now required to show the net investment in the lease at the beginning of the year to 31st December 2005 and explain what happens to the residual value. Okay, now looking at the solution, so the net investment in the lease is majorly the present value of the lease payment receivable by the lessor, which in most questions will be given to you. And it was given to us in this question as 232,502. That's the PV. Okay, if they don't give it to you, it's just to get the annuity. By the time you multiply this 80,000 per annum by the annuity factor, okay, over 3 years, it should give us this 232,000. But most questions will give you this PV of lease payment receivable. Then you would then add additional amounts that the lessor believes he can get. Okay, which is the present value of unguaranteed residual value. And this unguaranteed is 10,000 because the guaranteed is 40 and the lessor believes he can get 50. So there is a difference of 10 that has not been guaranteed. And don't forget, residual value is happening in the future. We need to get the present value of that. So the present value of this 10,000 using the rate of 9.2% given in the question. So that's 1 plus R will give us 1.092 raised to power minus 3. If you punch your calculator, you multiply that by 10,000, you get 7,679. If you add that to the 232,000, you get 240,000. And that is the net investment in the lease at the beginning of the year. Now, what happens at the end of the year? So, in 2003, at the beginning, we got 240,181 from here, what we got from here. Since the lease rental or lease income is paid at the end of every year, so that means we're going to add the finance income first, which is 9.2% of 240,181. And that gives us 22,097. If you add that to this 240,000, then, I mean, in the year one, that will have unwound the discount. That gives us 262,278. Then we start getting our money back as the lessor. So we received 80,000 in the first year. That brings what we are expecting, our net investment or lease receivable to 182,000, which will be carried forward to the next year. 182,278. Then you apply the 9.2% on this amount again. That gives us 16,770. If you add that to the 182, we have 199,047. Deduct the lease rental again of 80,000. It brings down the amount to 119,047. You carry it forward. Then you apply the 9.2% again of 9. Yeah, that gives 10,952. When you add that to the 119,000, we get 130,000. You remove the 80,000, then we are left with this 50,000. Yes, we have to be left with 50,000 because that is the amount of residual value that is remaining. However, this 50,000, if the lessor is able to sell the asset for 50,000, then fine, good. The transaction ends there. But if for whatever reason, the lessor is unable to sell these assets for up to 40,000, if he sells these assets for, let's say, 34,000, then it should be an obligation on the lessee to make it up to 40,000. So he will help him top it up with 6,000 because the lessee has guaranteed 40,000. Okay, so we don't really know it until that incident happens. It's until we know how much the lessor eventually sells it. That will determine how we're going to treat this 50,000 off our books. But for now, you are done with what you are required to do. Okay, that's for the lessor. Let's solve another question again. Now, this one talks about able leasing. He said the guy arranges finance arrangement for its customers for bespoke equipment acquired from manufacturers. Able leasing leased an item of equipment to a customer commencing on 1st January 2005. The expected economic life of the asset is 8 years. The terms of the lease were 8 annual payment of 4 million commencing on 31st December 2005. The lessee guarantees that the residual value of the asset at the end of the lease will be 2 million, although able leasing expects to be able to sell it for its part for 3 million. The present value of the lease payment, including the residual value guarantee, discounted at the interest rate implicit in the lease, is 6.2%, was 24.9. This was equivalent to the purchase price required. We are now required to discuss the accounting treatment of the above lease in the financial statement of able leasing pool for the year ended 31st December 2005, including relevant calculations. Okay, walk to the nearest 0.1 million. I'm going to ignore this one just for simplicity for you guys. Okay, so, I mean, similar to what we have done earlier, able leasing is the lessor. He has leased an asset and is going to be getting 4 million per annum in arrears. And the lessee has guaranteed him 2 million, but he believes that he can get 3 million. That means there's an unguaranteed of 1 million. And like I told you, the examiner will always give you the PV of the lease payments, including the residual value guarantee. Yeah, of course, they will have factored in the residual value guarantee in the rents the tenant will be paying, that the lessee will be paying. So it's included already. It is not at the end of the deal that they will start arguing around that. They will have included it in the lease payments that the lessee would but not in all cases, it depends on the agreements anyway. But substantially, it will have been included. Okay, so we are now asked to discuss the accounting treatments in the financial statement. So here, they want us to prepare a financial statement. So for lessor, the first thing you must always do in the exam is to determine net investment in the lease. And that's the only thing you just need to do for the lessor, because the lessor is going to recognize that asset from his books. We will now be left with a net investment in the lease. Now, this net investment in the lease at the beginning of the year will determine the PV of the lease payments receivable by the lessor, which they have given us in the question of 25.9 million. They gave us in the question. They will always give you this. If they don't give you, it's just to get the rent is collecting annually multiplied by the annuity factor. Then you add the present value of the unguaranteed residual value. Remember, the lessee guaranteed the lessor 2 million, but the lessor believes he can get 3 million. There's a difference unguaranteed of 1 million, which we need to bring to today's value by getting the present value. So present value of unguaranteed residual value is this 1 million multiplied by 1 plus 6.2%. That's 1.062 raised to power minus 8, the duration. And that brings us to 618 from 1 million. By the time you add that to 25.9, it gives us 26,518 as the net investment in the lease. So at the end of the year, at the end of 2005, at the beginning, it was 26,518. add finance income of 6.2%. If you apply 6.2% of on 26,518, you get 1,644. Deduct your lease rentals of 4 million, it brings it down to 26,162, and that's it. So in our accounts, in the statement of financial position, you just get your net investment in the lease, and you have that 24,162. For asset side, you don't have to break this one down into current and non-current like we did for liability. No, it's not necessary for asset. And in the statement of financial position, we would have, statement of profit or loss for the year ended, our finance income will be 1,644. Okay, so the book of the lessor is never going to be more than this. Never. So you understand this too, you are good. Now, the only additional thing is this, and ICANN has not really come out with this aspect, right? And this is a scenario whereby the lessor happens to be a manufacturer or a dealer of that item. For example, the lessor leases a car, right? Under a finance lease, of course. And that is what the lessor also sells as his principal activities. He sells car. Imagine you have a car shop that you sell cars. You now lease one of your car, right? You lease it. That is, instead of you to sell outrightly and collect your money, you decided to lease. Okay, IFRS 16 calls that kind of lessor. They call him manufacturer or dealer lessor. You see, because that is what this guy also sells normally. And ordinarily, if he has sold it outrightly, he will have recognized like a revenue and also cost of sales, and he will have gotten a gross profit. But for the fact that he has leased it, it goes to show that it will just account for a net investment in the lease. But we don't want the revenue being understated. We don't want the cost of sales being understated. So we want this guy to also recognize that. So whenever we have a manufacturer or dealer lessor, IFRS 16 says that in addition to recognizing a net investment in the lease, like I've taught you earlier, which I also call lease receivable, he said that the manufacturer must also recognize a gross profit. And that gross profit is simply revenue minus cost of sales. And you know what revenue is. I've taught most of you IFRS 15, not all of you do. And I told you that revenue, the core principle of IFRS 15 is that the revenue you recognize in P&L must depict the consideration an entity is entitled to for the transfer of goods or services. So I will not be wrong if I say that the revenue here for the lessor should be equivalent to the net investment in the lease that I taught you earlier. Because if you look critically at that net investment in the lease, what it shows is the consideration the lessor is entitled to from the conveyance of that asset. So this revenue here should be the net investment in the lease. But we have a problem with that net investment in the lease, because that net investment in the lease contains two items. One of them is the present value of the lease payment, which is okay, that he will get. The second one is the present value of unguaranteed residual value. IFRS 15 does not like that one. IFRS 15 does not deal with what you think you will get. Its present value of unguaranteed residual value is saying that he thinks he can. No, IFRS 15 has nothing to do with what you think you can. Is what you will from the goods you have transferred. For that reason, the revenue that is recognized here is the lower of either the fair value of the asset, meaning if you're going to sell the asset outrightly, how much? That's the fair value of the asset, or the present value of the lease rentals. The present value of the lease rentals, solely that. The lower of the two is what we should recognize here as revenue. Then you match it with the cost, which of course is going to be how much you bought the asset, or the carrying amount of the asset, whichever is available. However, we have to deduct the present value of unguaranteed residual value. The only reason being that IFRS 15 didn't allow us add it to the revenue because he is not sure that he will get it. You can't add that to revenue. But we want that amount to have an impact in the gross profit. If you cannot add it to your revenue, deduct it from your cost. That is why we are deducting this present value of the unguaranteed residual value from the cost of the asset, so that ultimately the impact on gross profit is the same. I mean, this is straightforward. We're talking about somebody determining gross profit here, which is majorly revenue minus cost of sales. Revenue for this guy is the net investment in the lease. But there's an item in that net investment in the lease that IFRS 15 will never allow you to recognize as revenue, which is the present value of the unguaranteed residual value. Since we can't add it to the revenue, deduct it from the costs. It will have the same impact. The same. If you can't add it to the revenue, you cannot increase revenue, use it to deduct your cost. So that was what we did with that present value of unguaranteed residual value for us to get our gross profits. So simply, when we have a manufacturer or dealer lessor, in addition to determining net investment in the lease or lease receivable, we must also determine a gross profit, which is the revenue, which is going to be the lower of the fair value of the underlying assets and the present value of the lease payment. Compare that with the cost of sales, which is usually the cost of the assets. And now we have to deduct the present value of unguaranteed residual value. Now, let me put it in perspective to you with this question. It says a manufacturer lessor leases out equipment under a 10-year lease, finance lease. The equipment costs 32 million to manufacture. The normal selling price of this lease asset is 42 million. And the present value of the lease payment is 38 million. The present value of the unguaranteed residual value at the end of the lease is 2.2 million. Okay, I mean, the solution is here already. What they want is, how will this lessor account for this? So they already told us, if you look at this question, is a manufacturer lessor. Okay, so in addition to recognizing lease receivable, the manufacturer will recognize a revenue of 38 million. Why? Because the normal selling price of the asset is 42 million. The present value of the lease rentals or payment is 38 million. He uses the lower of the two as revenue. That is why we are going to recognize 38 million as revenue. The cost of sales is going to be the cost of the asset, which is 32 million, minus the present value of unguaranteed residual value of 2.2 million. By the time we do 38 million minus 29.8 million, that gives us 8.2 million as revenue, as our gross profit. Then the lease receivable, because in addition to this gross profit, it's going to recognize a lease receivable or net investment in the lease, which is ordinarily is the PV of the lease rentals, which is 38 million. Then you're going to add your unguaranteed residual value, which is 2.2 million. And that brings us to 40.2 million. Then at the end of the year, we increase this with interest and we reduce it with the lease rental, just as I've shown you earlier. And that is all for manufacturer or dealer lessor. And finally for today is operating lease. And for operating lease, is quite straightforward. It's very straightforward in the sense that if a lease is not a finance lease, then automatically it is an operating lease. And when we have an operating lease, it's usually a short-term lease, usually like 2 years or even sometimes 1 year, whatever it is. It's seen as a short-term lease in the sense that the asset is still coming back to the lessor. The way IFRS 16 says the lessor should recognize this is that the lessor should just recognize rent, the lease rental, in his P&L on a straight line basis. Again, the lessor should recognize the rent in his P&L on a straight line basis. That is the core principle here. And that is it. So if you look at this question, it says a lessor leases a property to a lessee under an operating lease for 5 years at an annual rate of 100,000. However, the contract states that the first 6 months are rent-free. Okay, so this is a typical way. It will never be more than this, how examiner asks questions on operating lease. Because if they know it's straightforward, that all the lessor needs to recognize is just the rent on the straight line basis. And straight line basis means that it's going to recognize equal amount of rent every year. So they will usually introduce like an incentive that, okay, the lessor gave an incentive. In this case now, they said the contract states that the first 6 months are rent-free. If you look at it closely, without this last sentence, then this question is straightforward in the sense that all we will have had to recognize is just 100,000 per annum every year in our P&L, and that is it. But introducing that the lessor allows 6 months rent free, that goes to show that in year one, the lessor is not going to collect 100,000. What the lessor is going to collect is 50,000 naira in year one. So we cannot now recognize 50,000 in our P&L and be recognizing 100,000 for the remaining years. That will negate what this standard is doing. So whenever you have a question like this, the first thing you need to determine is that, okay, how much are we actually collecting over the period? Since we are collecting 50,000 in year one, and because that 60,000, that 50,000 is that, okay, we are giving, the lessor has granted 6 months rent free. Out of 100,000, 6 months is half of the year now. So that means it's going to collect just 50,000. Now, if it's collecting only 50,000 in first year, that means it will collect the 100,000 for the remaining 4 years. So this guy is going to get 450,000 over 5 years. Okay? It is this 450,000 that you are going to spread over 5 years. By the time you divide 450,000 by 5 years, then you are going to recognize 90,000 naira to P&L every year. 90,000 to P&L every year. But there is something left. I mean, we have been able to, that's how you do it every time in the exam. They will tell you that, okay, because it's straightforward. It's just recognize rent to P&L every year, but on a straight line basis, equal amount every year. So the examiner will now tell you that, okay, the guy gave them a discount of 10%, or they gave them 6 months rent free, so that one of the years will not show a balance, right? So they will now want you to, they need you to determine how much are we actually collecting over the period. Then is that one you will now spread, just like we have divided 450 over 5. So we know that what goes to P&L is 90,000. But there is something here. Because if you look at it strictly, if 90,000 goes to P&L in the first year, right? So 90,000 goes to P&L. this 90,000 that goes to P&L is not what we are going to receive. That's not what we will receive. If you are convenient with double entry, this is an income, with credit income with this 90,000 P&L. You will debit that, okay, I'm expecting this income. Let's call it lease receivable in your current assets because you are expecting it this year. But how much are you going to get? You won't get 90 in the first year. What you are getting in the first year is 50,000. What happens to this balance of 40,000? What happens to this balance of 40,000? That means this balance of 40,000 will go to your P&L in this first year. Well, which year is this now? Let me say year one in this first year. Now, because we are having a balance of 40,000 now, I will call it receivable. I have to call it receivable. That means there will be a balance brought forward in year two. There will be a balance brought forward in year two of 40,000. Don't forget, we'll still recognize 90,000 to P&L because straight line every year. But now in this second year now, we'll collect the entire 100. We'll collect the entire 100,000. If you collect the entire 100, don't forget, we're expecting 40. We recognized additional income of 90. So our total expectation is like 130. So in year two now, we collected 100. So that means there's a balance now of how much? Of 30,000. Again, in year three now we are not expecting 30,000. We are still going to recognize 90K to P&L, and we are going to collect 100K. Now, we are expecting 90, right? Sorry, we're expecting 30, and we have recognized additional expectation of 90, bringing our total expectations of income to 120. We received 100 in year three. So our balance is now 20 as assets. It will go as assets. So in year four now, I will bring forward this 20,000, then additional 90 to P&L. I would receive 100. Then that brings my outstanding to 10 that I'm expecting. Then in the final year, which is year five, I have 10 that I'm expecting, additional expectation of 90. I receive 100. Then to balance out. Okay, I just had to do this because the examiner might be funny, right? Especially if a question like this comes in a question where they ask you to prepare statement of profit or loss and statement of financial position for a particular year. So they might not ask you to do all of this, but I needed you to see the flow. So in year one alone that they will ask you to do in the exam now, 90,000 goes to P&L, quite all right. But 40,000 must also show in your asset. 40,000 must also show in your asset. And from what we have shown now, that means this 40,000 is like a non-current asset. Because we did not get everything until it was over a very long period of time, like over 4 or 5 years. So this you need to take note of when it comes to operating this. And that is it for IFRS 16 on leases. I mean, there are other aspects of IFRS 16 that I just intentionally want to mellow down because ICANN has never asked it, and I don't see them starting these days. I teach it, but it's usually an entire stress for my students, and because I like you that you won't find it in the exam, which is this sales and lease back. So I'm not going to talk about it, and I'll just advise you mellow down on it to confuse you, to waste your time before you understand it. Ultimately, you might not find it in the exam. Okay, so please master these few principles you have learned today and for last week, and clear out IFRS 16, understand it deep down, watch these videos if you have time. It will go a long way to help you. So we're going to stop the class for today. And in our next class, we're going to be starting with IAS 36 on impairment of assets. So IAS 36, I mean, it's a very straightforward one. So it's something we'll start and finish in a class. Do we have any question?